Equity Market Update, March 2020. The key highlights of equity markets in FY20 were S&P, BSE Sensex and Nifty 50 ended the year with large negative returns, but still outperformed mid-cap and small-cap indices. After corrections of mid-caps and small-caps, long-term returns of large caps and mid-caps and small-caps have now largely converged. Performance of major sector indices was negative for the year, with metals, auto, capital goods, and banking significantly underperforming. Globally, all major indices like S&P, FTSE, DAX, Nikkei, Shanghai, etc. also delivered negative returns, but most outperformed Nifty 50 for the year. FPIs sold massively during the month of March 2020, with net equity outflows of $8.3 billion, but still ended FY20 with net inflows of $1.3 billion. The size of outflow in March 2020 was the highest ever in 1 month and was approximately 0.4% of the Indian market capitalization. This resulted in equities falling significantly during the month. Net inflows in domestic equity-oriented mutual funds were INR 9,958 crore in February 2020 compared to net inflow of INR 7,696 crore a month ago. For FYTD20 till February 2020, total flows in domestic equity-oriented mutual fund stood at INR 55,691 crore. Outlook. As on 31st March 2020, Nifty 50 was trading at price to earnings multiple of 13.5x based on FY21 estimated earnings and 11.1x based on FY22 estimated earnings. While multiples remain very attractive, in uncertain times like the current one, limited reliance can be placed on the price-to-earnings multiples for gauging valuations, as earnings are difficult to predict, especially for FY21. In our opinion, the Indian market cap to GDP is a better indicator of valuation of overall market. As of end March 2020, the Indian market capitalization is approximately 50% of GDP, a level seen last post-correction during global financial crisis in 2008-2009. Further, it is worth noting that the gap between 10-year G-Sec and 1-year forward Nifty 50 earning yield has turned negative and is significantly below 10-year average. This further indicates that equity markets are attractively priced. Markets thus hold promise over the medium to long term, in our opinion. With the sharp decline in mid-caps and small-caps since the beginning of 2018, significant divergence with large caps is not likely going forward. Further, Department of Investment and Public Asset Management Secretary recently mentioned that exchange-traded funds are going to be the less preferred route for divestments going forward. This should lead to better valuations of PSUs, as regular supply of shares through ETFs was a big overhang on their share prices. India's growth is likely to slow down in the near term, but the impact is not likely to be equal for all the sectors. The impact on consumption, discretionary and even non-discretionary, though to a lesser extent, will be felt for some time. Given that India is a services-led economy, and given the impact on airlines, retail, travel, tourism, etc., there should be impact on wages, especially of the lower income groups. This could result in a slightly more prolonged impact on consumption. However, direct impact of slowdown in discretionary consumption will be on stocks whose weightage in Nifty 50 is less than 15%. Apart from consumer discretionary, the sectors which are likely to be impacted most are aviation, tourism, hospitality, etc. Impact on sectors like large banks, utilities, pharma, oil and refining companies, telecommunication, etc., is likely to be limited. In view of the above, where risk appetite permits, investors should use this deep correction to their advantage by increasing exposure to equity funds. At times like these, perceived risk is higher than the real risk. Thus, there is merit in increasing allocation to equities in a phased manner or in staying invested as the case may be for those with a medium to long-term view and in line with individual risk appetite. It is advisable to invest one's total investable surplus of risk capital in 2 to 3 phases over the next few weeks or months. One significant tranche should be deployed now, because markets are down 20 to 30%, and the other portion should be invested over a few weeks or months. Historically, it has been observed that investments made during the time when FPIs are large sellers have yielded strong returns over medium term. Significant delay in containment of coronavirus, adverse global events, sharp rise in crude oil prices, sharp moderation in equity-oriented mutual funds flows, delays in NPA resolution under NCLT are key risks in the near term. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.